You have 48 hours to save the world. That's what they told us. September 13th, 2008. Lehman Brothers was dying. IG was next. Then Merrill Lynch. Then Morgan Stanley. Then Goldman Sachs. Then everyone. The dominoes were falling. And if we didn't stop it in 48 hours, every bank in America would collapse. Your ATM would stop working. Your credit card would be declined. Your paycheck wouldn't clear. Grocery stores would run out of food because supply chains run on credit. Society as we know it would break down. I was in the Federal Reserve that weekend. I saw the plan they came up with. And I'm going to tell you something that will make you question everything. They didn't save the economy. They saved themselves. And they made you pay for it. Here's how they did it. My name doesn't matter. What matters is what I witnessed. In September 2008, I was working as an analyst at the Federal Reserve Bank of New York. Not the chairman, not a big shot. Just someone who happened to be in the building when the world almost ended. Let me take you back to Friday, September 12, 2008. It was a beautiful autumn day in Manhattan. The kind of day where you'd never guess that the entire global financial system was about to implode. I walked into 33 Liberty Street. That's the address of the New York Fed. At 7:30 a.m. Like I did every morning. But this morning was different. The energy in the building was electric. And not in a good way. People were moving faster, talking quieter, and the phones would not stop ringing. By 9 a.m., I knew something catastrophic was happening. Lehman Brothers, one of the oldest, most prestigious investment banks on Wall Street, was going bankrupt. And when I say bankrupt, I don't mean having a bad quarter. I mean totally, completely, irreversibly insolvent. Now, let me explain what Lehman Brothers actually was, because this is crucial to understanding why everyone was panicking. Imagine you're playing Jenga. You know, that game where you stack wooden blocks and remove them one by one until the tower collapses. Well, the global financial system in 2008 was like a giant Jenga tower. And Lehman Brothers wasn't just any block. It was one of the load-bearing blocks in the middle. Lehman Brothers had $639 billion in assets. They had millions of contracts with other banks, hedge funds, pension funds, insurance companies. Everyone. If Lehman collapsed, all those contracts would become worthless. All those other institutions would lose billions, and then they might collapse, which would cause more institutions to collapse. This is called systemic risk, and it's every central banker's nightmare. But here's what nobody outside that building understood. Lehman wasn't the disease. Lehman was just the sim. Let me rewind even further because you need to understand how we built this house of cards in the first place. It all started with something that sounds boring but is actually insane. Mortgage-backed securities. Here's how it worked. In the early 2000s, banks discovered a magic trick. Instead of just lending someone money for a house and waiting 30 years to get paid back with interest, they could do something clever. They could bundle thousands of mortgages together, slice them up into pieces, and sell those pieces to investors as mortgage-backed securities. Suddenly, a bank didn't have to wait 30 years. They could make their money immediately and pass the risk to someone else. Sounds smart, right? Well, here's where it gets crazy. Because banks were selling these mortgages so quickly, they stopped caring whether people could actually afford to pay them back. Why would they care? It wasn't their problem anymore. They'd already sold the mortgage to someone else. So banks started giving mortgages to anyone with a pulse. No job? No problem. No income? No problem. No documentation? No problem. These were called ninja loans. No income, no job or assets. And then, and this is where it gets truly insane, they started lying about how risky these mortgages were. They took all these terrible mortgages, bundled them together, and got rating agencies to stamp them with AAA ratings. That's the same rating as US Treasury bonds. supposedly the safest investment in the world. So pension funds, insurance companies, foreign governments, they all bought these safe investments, except they weren't safe at all. They were time bombs. And every major bank on Wall Street was playing this game. Lehman Brothers, Bear Stearns, Merrill Lynch, Citigroup, Bank of America. Everyone. They were all making billions of dollars. Their CEOs were getting $100 million bonuses. Everything was great, until people started defaulting on their mortgages. First, it was just a trickle, a few foreclosures here and there. But then housing prices started falling, and when housing prices fell, people who had bought houses they couldn't afford started walking away from their mortgages. Why keep paying for a house worth $200,000 when you owe $400,000 on it? The trickle became a flood, and suddenly all those AAA-rated mortgage-backed securities were worthless. Banks started announcing billions in losses. In March 2008, Bear Stearns collapsed and had to be bought by JP Chase for pennies on the dollar. Everyone on Wall Street told themselves, okay, that was bad, but it's over now. Bear Stearns was the weakest link. Everyone else is fine. They were wrong. By September 2008, Lehman Brothers had lost over $45 billion. Their stock price had dropped 95%. And now they were about to become the largest bankruptcy in American history. But here's what terrified everyone in the Federal Reserve that Friday morning. Lehman wasn't going to die alone. Friday, September 12, 2008, 6 p.m. I was supposed to go home. I had plans. But then my supervisor came over and said, cancel your weekend. Nobody's leaving. By 8 p.m., the building was more crowded than I'd ever seen it. Senior officials from the Federal, the Treasury Department, the SEC, and then the CEOs started arriving. Jamie Dimon from JP Chase, John Mack from Morgan Stanley, Lloyd Blankfein from Goldman Sachs, Vikram Pandit from Citigroup, John Thain from Merrill Lynch. These were the most powerful people in finance, the masters of the universe, and they were all gathering in a conference room on the first floor of the New York Fed. I wasn't in that room, I was too junior, but I was in the building running analysis, pulling data, and listening to the people who were in that room when they came out for coffee or to make phone calls. And what I heard was terrifying. The plan was simple, at least in theory. Convince one of the big banks to buy Lehman Brothers over the weekend, before the markets opened on Monday. If Lehman went bankrupt, it would trigger a panic. So they had to find a buyer. There were two potential buyers, Bank of America and Barclays, a British bank. By midnight Friday, it looked like Bank of America might do it. There was hope. But then Saturday morning came, and everything fell apart. Bank of America pulled out. Why? Because they'd found something better, Merrill Lynch. Let me explain how insane this is. Merrill Lynch was also in trouble. Not as bad as Lehman, but bad enough that they knew they might be next. So overnight, literally overnight, Bank of America decided to buy Merrill Lynch instead. That left Barclays as the only option for Lehman. Saturday afternoon, it looked like Barclays would do the deal. British regulators were on conference calls. Lawyers were drawing up contracts. There was hope again. But then Sunday morning came, and the British government said no. Why? Because buying Lehman would have destroyed Barclays too. The British government essentially said, this is America's problem, not ours. We're not going to let a British bank commit suicide to save Wall Street. And just like that, Lehman Brothers had no buyer. By Sunday afternoon, September 14, 2008, everyone in the building knew the truth. Lehman Brothers was going to file for bankruptcy. The fourth largest investment bank in America was going to collapse, and nobody knew what would happen next. I remember standing in the hallway at around 4 p.m. on Sunday. A senior Fed official walked past me on his phone. He was speaking very quietly, but I heard him say, "Start calling the other banks. We need to know who else is going down. Who else is going down? That's when I realized this wasn't about saving Lehman anymore. This was about figuring out who was next and trying to stop the dominoes from falling. Monday, September 15th, 2008. Markets opened. Lehman Brothers officially filed for bankruptcy. $639 billion in assets gone. Thousands of employees walked out of their offices carrying boxes of their belongings, many of them crying. The Dow Jones dropped 504 points. The S&P 500 dropped 4.7%. It was the worst day on the stock market since 9/11. But that wasn't even the real problem. The real problem was AIG. AIG, American International Group, was one of the largest insurance companies in the world. They had $1 trillion in assets. They insured everything: homes, cars, businesses, ships, planes, everything. But they had also sold something called credit default swaps. Here's how credit default swaps work. And I'm going to explain this as simply as possible because it's crucial. Remember those mortgage-backed securities one mentioned earlier? The ones that turned out to be worthless. Well, banks who owned those securities got worried. So they went to AIG and said, "Hey, will you insure these securities for us? If they go bad, you'll pay us back." AIG said, "Sure, that'll be $X billion, please." AIG collected billions of dollars in fees for selling this insurance, and they thought they were geniuses because they never thought they'd have to pay out. Mortgages never all go bad at once, right? Wrong. When Lehman Brothers collapsed, suddenly everyone holding mortgage-backed securities realized they were worthless. So they called AIG and said, "Hey, remember that insurance you sold us? Time to pay up." Except AIG didn't have the money. AIG had sold over $500 billion worth of credit default swaps. And if they couldn't pay, every single bank that had bought insurance from them would lose billions, which meant those banks would collapse, which meant more banks would collapse. AIG was even more dangerous than Lehman Brothers. And by Monday afternoon, September 15th, AIG stock had dropped 60%. They were spiraling. They were going to collapse within 24 hours. This is when I heard the phrase that still gives me chills. If AIG goes down, the entire system goes with it. Monday night, September 15th, 2008, 10 p.m. Fed Chairman Ben Bernanke and Treasury Secretary Henry Paulson were in emergency meetings with President George W. Bush. Here's the situation they faced. Option 1. Let AIG collapse. Let the free market work. Banks that made bad decisions should fail, right? That's capitalism. But if they chose this option, every major bank in America would fail within weeks. Your bank account would be frozen. Your 401k would be worthless. Credit would disappear. Companies couldn't make payroll. Supply chains would break down. It would be the Great Depression 2.0. Option 2. Bail out AIG with taxpayer money. But here's the problem. Just 2 days earlier, they'd let Lehman Brothers collapse. If they saved AIG now, it would look like they were picking winners and losers, saving the companies that were politically connected and letting others die. Also, bailing out AIG would cost, well, nobody even knew how much. $50 billion, $100 billion, $200 billion. And where would that money come from? Taxpayers. You, me, everyone. By midnight, the decision was made. The Federal Reserve would loan AIG $85 billion. In exchange, the U.S. government would own 80% of the company. It was the largest government intervention in a private company in American history. But here's what nobody told the public. $85 billion wasn't going to be enough. Tuesday, September 16th, 2008. Markets opened. Everyone knew about the AIG bailout. There was relief for about 30 minutes. Then the panic started again. Morgan Stanley's stock dropped 24%. Goldman Sachs dropped 14%. Washington Mutual, the largest savings and loan in America, was in free fall. The problem was simple. Nobody trusted anyone anymore. In the financial system, banks lend money to each other every single day. That's how the system works. But now, nobody wanted to lend to anyone because they were afraid they wouldn't get paid back. This is called a credit freeze, and it's lethal. When credit freezes, everything stops. Companies can't make payroll. They can't buy inventory. They can't function. The entire economy grinds to a halt. By Wednesday, September 17th, even the safest money market funds were breaking. People were pulling their money out of everything. I watched this happen in real time from inside the Federal. The data coming across our screens was apocalyptic. The financial system wasn't just sick, it was dying. And this is when the real plan came together. Thursday, September 18, 2008, morning. Treasury Secretary Hank Paulson walked into a meeting with congressional leaders from both parties. He told them, "If we don't act now, we may not have an economy on Monday." And then he asked for $700 billion. $700 billion to buy toxic assets from banks. $700 billion to bail out the people who caused the crisis. $700 billion of taxpayer money. This would become known as TARP, the Troubled Asset Relief Program. Some congressmen were furious. Why should we bail out Wall Street? Let them fail. Paulson's response was chilling. If we don't do this, unemployment will hit 25%. Your constituents won't have jobs, won't have money, won't have food. This isn't about saving Wall Street. This is about preventing another Great Depression. He was right, and he was wrong. The bailout passed, $700 billion of taxpayer money, but that was just the beginning. Over the next few years, the Federal Reserve would inject over $7.7 trillion into the financial system through various programs. Let me say that again. $7.7 trillion. Where did that money come from? They just created it. That's what central banks do. They type numbers into a computer and boom, money exists. And where did that money go? It went to the banks. The same banks that caused the crisis. Bank of America got billions. Citigroup got billions. Goldman Sachs got billions. Morgan Stanley got billions. And here's the crazy part. Most of those banks paid the money back with interest. So technically, the government didn't lose money. Some people even made money. But here's what they don't tell you. While the banks got trillions in bailouts, regular people got nothing. If you lost your job in 2008, nobody bailed you out. If you lost your home to foreclosure, nobody saved you. If your retirement savings got cut in half, nobody made you whole. 9 million Americans lost their jobs. 10 million people lost their homes. The median household lost 40% of their wealth. Meanwhile, the bankers who caused the crisis, they kept their jobs. They kept their bonuses. In fact, in 2009, Wall Street paid out $20 billion in bonuses. Let me repeat that. In 2009, the year after they crashed the economy and got bailed out by taxpayers, Wall Street paid itself $20 billion in bonuses. Not a single major bank executive went to jail. Not one. The government said the banks were too big to fail, but apparently the American people were small enough to fail. So let me tell you what really happened in those 48 hours in September 2008. They didn't save the economy. They saved the banking system. And there's a difference. The economy is you and me. Small businesses, workers, families. The economy is real people making real things and providing real services. The banking system is, well, it's a giant casino where rich people gamble with other people's money. And when that casino almost collapsed, the government had a choice. Save the casino or let it burn and help the people who got hurt. They chose to save the casino. Why? Because the people running the government were the casino. Hank Paulson, the Treasury Secretary who pushed for the bailout. He was the former CEO of Goldman Sachs. He'd made $500 million on Wall Street before joining the government. The people making the decisions were the same people who benefited from those decisions. And here's the really terrifying part. They do it again, because here's what the 2008 crisis taught the banks. If you take huge risks and win, you keep the profits. But if you take huge risks and lose, the government will bail you out. This is called moral hazard, and it means the next crisis is inevitable. In fact, we almost had another one in 2019. You probably didn't hear about it because it happened in something called the repo market, which sounds boring, so the media didn't cover it. But overnight, the Federal Reserve had to inject $75 billion, then $105 billion, then eventually over $6 trillion to prevent another collapse. Just 11 years after 2008, and we were already on the brink again. The system is broken. It was broken in 2008. They fixed it with duct tape and bailouts, and now it's broken again. So what's the lesson here? What do you need to understand about how the financial system really works? First, the game is rigged. The people at the top of the financial system have convinced the government that they're too big to fail, which means they can take massive risks because they know they'll get bailed out if things go wrong. Second, your money isn't as safe as you think. In 2008, people woke up one day and found out their retirement savings were gone. Their homes were worth half what they paid. Their jobs had disappeared, and there was nothing they could do about it. Third, it can happen again. In fact, it will happen again, because nothing fundamentally changed. Banks are bigger now than they were in 2008. They have more power, more influence, and more ability to crash the system. Fourth, the Federal Reserve has more power than you realize. They can create trillions of dollars with a keystroke. They can decide which banks survive and which don't. They can manipulate interest rates, manipulate markets, manipulate the entire economy. And they're not elected. They're not accountable to you. They're accountable to the banking system. Fifth, when the next crisis comes, and it will come, you need to be prepared, because the government will save the banks, but they won't save you. I started this story by telling you that in September 2008, they had 48 hours to save the world. But here's the question nobody asks. Did they actually save it? Or did they just delay the inevitable? Because from where I'm sitting, looking at the data, looking at the debt levels, looking at the risks building in the system right now, I don't think they saved anything. I think they just kicked the can down the road. The next crisis is coming. Maybe it's in 1 year, maybe it's in 10 years, but it's coming. And when it does, you need to understand what's really happening, because they're going to use the same playbook. They're going to tell you the banks need to be saved. They're going to tell you it's for your own good. They're going to tell you there's no other choice. But now you know the truth. In 2008, they had a choice. They chose to save the people who caused the crisis instead of the people who were hurt by it. They chose the banks over you, and they'll do it again, unless we demand something different. So here's what I want you to do. First, share this video. Most people have no idea what really happened in 2008. They think the government saved the economy. They don't realize the government saved the banks and left everyone else to suffer. Second, educate yourself. Learn how the financial system actually works. Learn what derivatives are. Learn what the Federal Reserve does. Learn who really has power in the system, because knowledge is the only defense you have. Third, demand accountability. Contact your representatives. Tell them that banks should not be too big to fail. Tell them that executives who commit fraud should go to jail. Tell them that the next time there's a crisis, regular people should get bailed out, not just banks. And fourth, and this is most important, protect yourself. Because when the next crisis hits, you need to be ready. I was inside the Federal Reserve in 2008. I saw what happens when the system breaks. I saw the panic, the fear, the desperation, and I learned one thing above all else. When the chips are down, the people in power will save themselves first. So don't count on them to save you. Save yourself. If you found this video valuable, please hit that subscribe button and turn on notifications. I have more stories from inside the financial system that you need to hear. Drop a comment below. Do you think the 2008 bailout was necessary? Or do you think they should have let the banks fail? I want to know what you think. And if you want to dive deeper into how the financial system really works, check out my next video where I explain exactly what the Federal Reserve is, how it was created, and why that matters more than you realize. Thanks for watching. And remember, the next crisis is coming. Be ready.